So joining me now for more is Andrew Lipow, Lipow Oil Associates President. And Andy, it's good to have you on. And I want to start right there because there does seem to be this divergence in the public narrative. We just mentioned some of that White House statement that oil companies are ready to go in. But then we've also been hearing, and we've seen this with some of our own reporting here on CNBC, that companies do seem to be very hesitant to do so, at least right now, perhaps in part because of the governance and stability questions. How does this play out?
Well, good afternoon, Morgan, and thanks for having me. I think that the oil companies may be ready and willing under a certain set of circumstances to go back into Venezuela. But in the near term, I think, the industry is looking, the Venezuelan oil industry is in such a state of disrepair that even to get more oil out of the ground, you've got to go and assess the state of the infrastructure, number one, to get that oil to market, and number two, to significantly invest in the power grid in order to supply reliable electricity to run those production facilities. So while in the near term, I'm not expecting much change in the amount of oil coming out of Venezuela, we might see some incremental supplies coming out of Chevron, who already has boots on the ground. But as far as having a material impact on world oil supply, you're looking at $10 billion a year for the next 10 years to result in a substantial increase of maybe several million barrels a day 10 years down the road.
Interesting. And of course, we're talking about heavy sour crude, the most direct competition perhaps with Canada's oil sands crude. So if and when that were to come online, and if and when sanctions were to be lifted and those exports were to make their way to the U.S., what does that mean for the mix of oil imports, and how does that factor into the refining capacity, especially when you think about domestic players?
Well, certainly this is good news for Gulf Coast refiners. And if we look all the way back to 1997, the U.S. imported 1.4 million barrels a day of Venezuelan oil. And that would include companies or their successors such as Chevron, Citgo, ExxonMobil, Marathon, Phillips 66, PBF Energy, and Valero. So they're all ready to take increased volumes of Venezuelan oil. And as you point out, that would be competition for Canadian heavy oil. But now that there is new pipeline capacity out of Alberta to the Pacific side, I think China would step in and buy those additional supplies. What you might see on the Gulf Coast is a reduction in supplies from the Middle East, namely heavy sour crude coming in from Iraq, Kuwait, or even Saudi Arabia.
I do want to go back to the China piece of this because Venezuela pumps what? Sub 1 million barrels of oil per day. Most of what they export is going to China. You do have this embargo in place. What happens to that supply? And perhaps just as importantly, maybe at least in the near term, if it is diverted away from China, do you start to see the realization of what's going on in Venezuela in real time in spot prices as China goes elsewhere into the market to try and make up that crude?
Well, it's really difficult to assess where this roughly 350,000 barrels a day is going to go, since the U.S. continues to impose sanctions on the shadow fleet of tankers. So that impacts on the Chinese ability to lift oil out of Venezuela. However, if they use non-sanctioned tankers, that would be a workaround that could keep the oil flowing. Of course, China is losing access to very inexpensive and highly discounted Venezuelan oil production. So they would look for alternative sources, one of them being Canadian oil, but the other could be supplies out of the Middle East.